The major averages are closing in on their first negative quarter of the year, with the Nasdaq down more than 8% from its summer high. And our next guest says the setup for stocks could get choppier from here into year end. Let's bring in Elizabeth Burton of Goldman Sachs. Elizabeth, good to see you.
Hey, Mike. Good to see you.
So we have, as we said, the Nasdaq down 8%. Global index is down at least 6 or 7%, but also bonds are off. Obviously, we know, to say the least. Where does that leave you in terms of figuring out where some opportunities have been created and where there's a better risk reward?
Well, what's interesting is we just completed our annual global private alternative investment survey at Goldman Sachs. It's available on our website. We found that investors are actually becoming more constructive on the markets, with at least 90% of them thinking that the markets are stabilizing or improving over the last year.
Okay.
What's also interesting is in that same report, they think markets such as private markets, private equity can be expensive, while and public equity expensive, but they're continuing to allocate on the private market side. They see public fixed income and public real estate as somewhat cheaper.
Does that also fit with how you're viewing the world, or how you at the firm would suggest you should position at this point?
I think there are some differences.
Yeah.
One interesting thing from the report is that investors are much more bearish on the Eurozone, but some of the opportunities we see for diversifying your portfolio could be in the Eurozone. For example, as you know, tech, healthcare can be cheaper there. There's also some selective value plays there that we like, European banking sector, energy stocks, et cetera. So there are some things in the survey that don't quite match with what we're seeing on the opportunity side.
What's your take on just how asset markets in general are digesting this change on the yield front? Whether it's going to last a long time or not, the cost of debt has been going up. You're seeing hurdle rates rise. Cash now pays you. Does that change the landscape in a fundamental way?
For me personally, and I've been very repetitive on this, I think one of the things that investors should consider in this rising rate environment, and in particular on the fixed income side, is the question that I keep getting from investors is, when should I add duration back in? What should I do with fixed income? And if we're in an environment where inflation remains sticky and high, and the correlation stays somewhat positive between bonds and equities, it doesn't necessarily mean that you shouldn't still shy away from fixed income. There are still positive benefits to adding fixed income into your portfolio, especially at these levels of interest rates. But it also means that you may need to look towards real assets for other sources of diversification, which we are seeing investors doing. We're seeing infrastructure, we're seeing real assets minus real estate becoming more interesting.
So that would be things like commodities or infrastructure or things like that?
Sure. So, yes, definitely in commodities. And I know one of my colleagues was on today talking about the opportunities in the copper market.
Right.
Institutional investors, that's a lot more challenging. You don't just go out and buy commodities typically. You can overweight cash to a certain extent. What's one interesting play that I've been hearing lately is real assets that are more digital in nature or have digital components, so like sports franchises or buying into the world of competitive sports.
Yeah, people have to range pretty far, I guess, to get non-correlated assets of certain types. If we're back in a world, and I assume you think this is the case, where stocks and bonds are going to move together as they generally did in the 80s and 90s.
Well, interestingly enough, based on history, you would actually expect that those correlations might come down over the next 6 months, but they could also stay higher. We don't have total clarity what's going to happen on the long end of the rate range, right? So there could be a period of time where that correlation stays sticky. What's interesting to me is that I thought fiscal year end ends for most institutions in July. We did not see a lot of asset allocation changes, and I thought that we would. So when you want to change your portfolio, you just go out and do it, right? You call an audible. If I'm an institution and I want to go out and change my portfolio, well, I might have to go find a new offensive coordinator, and that could take 6 months and get my GM's buy-in, and then they might get rid of me.
Right.
So it's just a different game.
For sure. And just finally, because you mentioned institutions like, let's say, pension funds having their fiscal year there, I've seen the case made that in general, defined benefit pension funds may be overfunded right now, and therefore they might as well just sit there in cash and fixed income and safe income producing assets as opposed to adding risk.
I think it's going to be challenging for them to just sit there. I think, to your point, I think they might not be changing drastically their allocations. What I have seen happen is totally different from last year. I'm hearing more questions from institutions on, can we hedge our portfolio? Reverse 12 months, they were saying, how can we diversify within asset classes? Now they're asking, what do you think about a total portfolio hedge to limit our exposure to a massive market drawdown?